Hello friends, welcome to this video, and in this specific video we are going to understand a very interesting subject called about bonds, but we are going to see the risk associated with bonds. Yes my friend, bonds as well, which are low risk instruments, do carry some risk, low risk, but they do carry a systematic risk which is associated with the financial system as a whole. And we'll also see, along with the risk, how can we mitigate those risks as an investor in bonds. So in my previous video, the link of which is in the description box, you can please have a watch on the video, and it's all about talking about what is bonds all about, who issues bonds, what are typical interest rates which the bonds pay to the investor, and also the critical factors of which you need to consider as an investor before you push in money into investing into bonds. So please share it to as many friends and relatives as possible so that they can also get an understanding that bonds do also have systematic risk. And after you understand those risks, I will also share with you what are the mitigation strategies which you can follow to mitigate those risks. So there are four risks associated with bond, top four risks. The first risk is the inflation risk, which we are all aware about, and inflation reduces our purchasing power. So something which is available for about 100 rupees today, maybe a burger, one single burger available for 100 rupees, and 4 years hence the same 100 rupees maybe won't even able to afford half the burger. So that's the decrease in the value of money over a period of time, and that is due to inflation. Inflation in our country, that is India, that's about 7% year on year, but nevertheless it's never like 7% every year on year. It's like sometimes 4%, sometimes 3%, sometimes it goes to like 6 or 9% as well. So RBI, the central government, regulates the supply of money so that the common man doesn't suffer sudden jerks in prices on a year on year basis, on a monthly basis. But nevertheless, if the bond is paying a coupon interest rate of an annual interest rate of about say 8%, and the inflation rate is about 9%, so that means it's eroding the value of money. So that is the risk which the bond carries, that's the inflation rate risk. And the second risk which it carries is about interest rate risk. As we all know in the previous video which I have shared, that when the interest rates actually rises, the bond prices have to fall. The existing bond prices have to fall so that the yield corrects and matches to the ongoing interest rates. And of course, the yield of the bond will correct to a much higher rate compared to the ongoing economical interest rates. But that is the risk the bonds carry. For example, now if you had purchased a specific bond, a 10-year bond for a period of 10 years, maturing after 10 years, so then if the interest rate then was about say 5% or 6%, you would have locked in for a period of 10 years. And then at a later point of time, the interest rates would have actually fluctuated. Maybe it would have gone like up, but then you'd be losing the higher interest rate because you have been locked in at like 5 or 6%, and the ongoing interest rate today is about like 9 or 10%. So as an investor in bonds, you have suffered the loss of interest rate risk because of the high interest rate regime at a particular point of time during those specific 10 years. So that is the second risk which the bond carries. The third risk that the bond carries is due to the same interest rate changes what happens during a period of time, due to which the bond price is also correct, which then associated with something called as the reinvestment risk. So that means if you want to reinvest the coupons or the interest which are being paid up by the bonds in the subsequent year, and subsequent year the bond price may turn to be higher. So when you reinvest this coupon back into the bond, then you'll have to end up with a lower percentage of coupon rate, the low percentage of payout for you in terms of coupons. So that is the risk, that is the reinvestment risk which the bonds carry. So wherein you have to buy the bond at a higher price compared to what you would have bought it at in the start or initially. So that is the third risk. The fourth risk is about liquidity risk. So liquidity is all about the ease of wherein you can, convert back your asset back into cash. So specifically with bonds, in the secondary market, when you want to sell bonds, you might, face the risk due to associated to interest rate, and also it could be like, the investors could be waiting for a great deal of time, for about 10 years. They don't wish to sell in the market, so they wait for the entire period of 10 years. So you may not find a buyer to liquidate your asset, that is your bonds. So that is the liquidation risk with the bond carries. So now that we have understood the risk associated with the bonds, that is the inflation risk, the interest rate risk, the reinvestment risk, and then finally the liquidity risk, the four risks. So let us understand the three strategies wherein you can mitigate all this risk. So the first strategy wherein you can mitigate all this risk, the systematic risk, especially the interest rate risk and the reinvestment risk, you can use a strategy called as bond laddering. So what is bond laddering? So as you know, you have a ladder, and the ladder has steps. So if you have an investment which you want to put into bonds, you take the entire portion of investment and divide it into equal portion, that is in equal steps. So you put those portion, you divide the entire portion of your investment into equal proportion by investing into different maturity levels, maturity periods. So for example, if you have 10 lakhs of investment which you want to do into bonds, then 10 lakhs you divide it into like 5 periods, or you divide it into 10 periods, and equally all maturating every 1 or 2 years. If it is for 5 periods, it is going to mature, that specific equal portion is going to mature every 2 years. Or if it is going to be for a period of 10 years, then the equal portion is going to mature every 1 year. So now, why do we do this? So that you do not face the risk of interest rate changes. Now, for example, if the interest rate changes go high, you have in that specific year a specific set of bonds which are going to mature in that specific year, because you have laddered it. You have divided your investment across different maturities. So it gives you a power wherein you can take advantage of the coupon payments and reinvest them back at a higher interest rate at that specific point of time. Or if the interest rates are low, you can take your own decision, because the principal is paid back in that specific year. You can decide on another asset to invest in that specific year. So that is the advantage of bond laddering. If you are still unclear how it is actually done, please drop in a comment, and I'll try to explain it more easy, so that it can become more easy for you to understand and invest into the bond market using bond laddering. But nevertheless, the second technique of mitigating the risk of interest rate as well as reinvestment risk is something called as matching the Macaulay duration. So you need to understand what is the duration you need to fulfill the financial goal or financial need, and that duration you need to match with the Macaulay duration, the duration of the bond. So that takes care of the risk automatically. So that is the another way of mitigating the risk of bonds. And the third method, the third and the final method of mitigating the risk is the barbell method. Barbell method, as you know, it's like a barbell, and the first portion of the barbell, the 50% of your investment you put into short-term bonds, and the other 50% you put into long-term bond. So what gives this gives you an advantage that the short-term bonds mature immediately. Then you can decide, depending on the ongoing interest rate, whether to reinvest the coupons into bonds itself or into another assets. So that's the advantage which you get out of the barbell method. Nevertheless, and because you have a long-term investment, it reduces, it gives you income on an ongoing basis on a regular intervals. So these are the three methods of how you can mitigate the risk associated with bond. The first method is, and most favorite method is actually bond laddering, and the second favorite method is actually barbell method, and the third, if you can, and it's mostly followed by institutional investors. That's why I have not covered too much about this topic for matching of the Macaulay duration. So that is mostly used by institutional investors for themselves. But nevertheless, individual investors also can use Macaulay duration to match the portfolio of bonds and match them exactly so that they can fulfill the financial needs based on the period of the bond. So that was all about this today's topic. And if you have able to understand about what are the risks associated and what are the techniques of how you can mitigate it, and if you can effectively do it for yourself, or if you have questions about how you can mitigate those risks, please feel free. Please do drop a comment in the comment section, and I'll reply back on the comment section or get back to you via email. See you. Bye.